a system that just ain't right. Gonna tear it down, gonna start a fight. Anarchy and numbers is my game. I'm the investor with no shame. Greed and corruption, that's the name of the game they play. It's all a shame. I won't play by their rules, I won't comply. Anarchy's the way. It's time to fly. I'll burn down the walls and break the chains, shatter the illusion.
And here we go. Welcome. I am Matt. This is the Anarchist Investor live, coming at you every Monday through Friday at 12 Eastern, talking about contrarian investments, markets, the economy, how to protect and grow your money without it getting stolen by some dirty banksters. Today, we are talking about, this is like every other day, man. We're talking about silver today. Look at this chart. This is freaking beautiful. I'm going to pan out. We're going to talk a little bit about silver and what the ramifications are of silver for, say, pricing in the future. There's all kinds of stuff happening as far as the central banks are concerned today. We got rate cuts. Everyone wants my rate cuts, to paraphrase the line from The Big Short. But a reminder before we get to that, give me a sub, a like, make sure to hit the notification bell, a follow, a share, and throw some feedback into the comments, what you're looking at, what you're interested in, maybe even your opinion of what I'm talking about, and we can have a discussion. All of that helps the algo. All of that helps this message get out there, and all of it is a help to me in the channel. So I want to say thank you in advance for that. All right, I'm going to take the banner down. What is going on with silver, ladies and gentlemen? Well, today we got rate cuts. Yesterday we got rate cuts. Everyone gets a rate cut. Canada cut yesterday. They were the first of, I guess, the news article I saw, the first G7 country to cut interest rates yesterday. The European Central Bank followed through with their promise that they telegraphed a rate cut this month. They did it this morning, and they have some mutant system where they have like 3 different types of interest or lending rates that are involved in their banking system. Well, they cut a quarter point on every single one of those. So all 3 of those interest rates got a quarter point cut. So we got a little bit of a rate cut euphoria going on in certain areas of the economy, certain areas of the stock market, aka the casino, definitely happening within the commodity space. And we'll talk about how that's playing out into crypto world. So before we get too much deeper into the charts, let me just pull things up here and talk about what's happening and why it's happening, most importantly. All right. So here's your confirmation. This story is out of Yahoo Finance. ECB cuts interest rates for the first time in 5 years to 3.75%. European Central Bank follows Canada. And also we got rate cuts from Sweden and Switzerland. I believe there was another couple of rate cuts today as well to follow suit with some other smaller European central banks. Or central banks that are in that, kind of European area, moving ahead of the Federal Reserve. So this is obviously going to put pressure on the Federal Reserve here in the U.S. to cut rates, because if you're not familiar with the dynamics here, when other countries cut rates, typically it weakens their currency relative to other countries that aren't cutting rates. The other way to think of that is the other countries that aren't cutting rates, their currency appreciates or basically deflates. Well, deflation is like the worst 4-letter word, and I understand it's not a 4-letter word, but it is like literally the worst word for central bankers. They cannot stand deflation, nor do they want any deflation, because God forbid they actually abide by sound economics. They want to continue the controlled destruction of their fiat currencies. Deflation is not in that script. It does not go along with controlled destruction via inflation. So the Federal Reserve, whether they like it to or not, is going to be forced into cutting interest rates. And they're either, and you can't tell me, they coordinate all the time. So they talk on the back end. So the Federal Reserve, here in the US, they knew the ECB was going to cut interest rates. They might even give them a blessing. Okay. They knew Canada was going to cut interest rates. They knew these other countries were going to cut interest rates. This is not, a surprise to the Federal Reserve here in the US. they all coordinate rate policy nowadays because it's basically this mutual, slow moving race to the bottom, right? Like they're all racing to get their fiat currencies to zero, but they're not trying to get there like tomorrow. They're trying to stretch out the race as long as possible. So they all kind of like sandbag it, if you will, and they all sandbag together. So they all like try and finish the race at the same time, and they all end up at zero. Well, the Fed's going to have to cut rates. It's just the writing's on the wall. Whether they do it this meeting or the next meeting, it's going to have to happen, which is why you see a lot of this market movement. Now, is this happening for the good reasons or the bad reasons? Well, what would the good reasons be? The good reasons would be the economy's strong. They've been restrictive in terms of their monetary policy, and they're cutting rates because they want to spur on some more growth in the economy. That would be the good reason, okay? And that's been the fairy tale they've been trying to sell everyone on, despite the fact that, like I talked about yesterday, 56% of people are like, yeah, this economy is in a recession. And people are like, no, it's not in a recession. You don't understand what a recession is. Times might be tough for you, but you don't get it. It's not a recession. And people are like, well, call it whatever the hell you want. It sucks. Okay. Well, that's not obviously the case. It is not the case where the economy is just, going very robustly forward and they want to spur on additional growth or support that growth. That is not the answer. Okay. Wealthy people are experiencing some continued prosperity. Everyone else is getting the short end of the stick. That's why they're having to cut rates. Well, this other story came up yesterday. I didn't really even talk about this payroll report yesterday. But so the private payroll number came out from ADP. When was this published? This was published yesterday. And this is out of CNBC. And it says private payrolls growth slows to 152,000 in May, much less than expected. Buried in here is also some prior revisions to employment numbers, meaning that the employment numbers were overcounted, because they almost are always overcounted. Because these people that are coming up with these survey numbers, this is all mathematical models and statistical extrapolation. It's like, the ADP number is actually based off of, I guess, how many checks they're cutting because they're a payroll company. But when it comes to like the BLS number, the actual federal number, they're not going and like calling up and being like, hey, how many people did you hire or fire this month? Like, what's the net change? They're not doing that. It's all based off of a mathematical model. There's seasonal adjustments and all this other BS that goes on. So it's basically a Fugazi number that's completely manipulated, okay, based off of whatever kind of story they want to tell. Well, this is showing you that the story that they've been telling all along isn't exactly what the story is, okay? And I would even make the argument that these are overstated, all right? But we're coming up short in terms of the expected job creation numbers. And in fact, this is probably going to be immediately preceding job creation numbers that will be with negative signs. There will be red numbers coming out of the job creation numbers, because for far too long, I think it's been like 12 months now, we've had companies reporting layoffs after layoffs after layoffs after layoffs. There's no way that happens in an economy and you're actually creating jobs. There's no way. There's no other place for those people to go. So in essence, the job creation numbers, I bet you, when we look back historically, will have some kind of connection with people falling out of the workforce. And so when they say like 152,000 jobs were created, especially like not so much here with the ADP, but with the federal number, when the federal number comes out, they'll say like, 212,000 jobs were created. The vast majority of those will probably be people that just left the labor force, and they just assume because there's not filings for unemployment that those people aren't counted anymore. And the mathematical model now spits out a positive number because of it. Okay. I'm pretty certain that's going to be the way it is, because that's almost always the way it is. 2008, things looked really great until all of a sudden they had to go through and post really bad numbers. And not only did they post really bad employment numbers, they went back and revised a bunch of numbers, and they realized that things were way worse the whole time, right? Leading up to it. So anyway, so that's the reason why we're cutting. It's because economies throughout the world, Europe, Canada, most of the Western economies, I mean, China's been trying to stimulate their economy for going on 12 months now, 18 months, and it seems to not be working at all, no matter how much money they throw at the problem. Um, those efforts to try and get things going here, keep the train on the tracks, they're not going well. Okay, so they have to revert to what they know, and what they know is easy money policy, artificially low interest rates, try and reignite inflation, and that's essentially what they're going to do. So how do we know that's happening? Because look at what's rising today. Okay, the casino is not really up. Like the stock market is flattish to down. And let me see if I can get the right window here. The casino is kind of down today, or at the very least flat. Okay, small caps are taking it on the chin today, meaning smaller companies. Money's not rotating into those smaller companies. If you would think that rate cuts are coming, you would think, and you had some kind of anticipation that the economy wasn't broken, that it was still functioning well, plus you were getting lower interest rates, you'd be dumping money into small caps because they would be the growth engine moving forward, assuming the economy is still intact. It is not. It has been, I wouldn't call it irreparably broken, but it has been very, very broken because of I would actually say the last 16 years, ever since 2008 and all of those interventions. But a lot of people would just point to since 2020 and 2021, the lockdowns, the supply disruption, the money printing, everything like that, right? Well, the casino's not really up today. It's slightly down. This could also be a buy the rumor, sell the news kind of situation. You'll probably see a continued upward bias to the stock market, however, because typically after you get that first rate cut, and again, we haven't been signaled of that from our Federal Reserve yet in the United States. So when that does come, I think there will be a lot of relief that's associated with it because a lot of people have been waiting impatiently for rate cuts for a while now. But once the cocaine gets injected back into the system, you get a little bit of a rally right after that, like that relief. Oh, thank God they're coming to the rescue. But then after that rally, you then get the actual reality of the situation. And the reality of the situation is that the economy is broken and that the economy will get worse despite the fact that central banks are cutting rates. Okay. The worst losses in the casino are always after the first rate cut. Right. Now, I argued last month that the Fed already cut. They already eased. It wasn't a rate cut. It was an easing because they drew back in terms of the quantitative tightening that they're doing, which is the other aspect of how they stimulated the economy with quantitative easing 1 and 2 and 3 and 4 and 5 and 6 from 2008 all the way through 2019 and leading into 2020. They pulled back on that already. So they've already waved the white flag. They've already signaled that they're willing to cut. They will they might not cut this month because they would lose credibility. If the Fed said, oh, we're looking at the numbers and they're reassuring or whatever, we think we can cut, and then they cut, that would be one thing. But they haven't said that. Jerome Powell's been very conservative in terms of, putting out the expectation of a rate cut. I would assume that during this meeting, they leave it flat and then telegraph that next meeting, all things remaining equal, that they're going to cut rates. Okay. But now let's look at what's actually reacting. Okay. Silver's obviously reacting. It's up. It was up over 4% at one point, like a couple of minutes ago. Okay. Gold's up. It's not up as much as silver was, but gold's up. It's had a bid. All right. Most of the commodity sector is up. Okay. If you look at DBC right here, this is the commodities ETF. It's up. All right. And this is the other thing to remember about rate cuts and that dynamic in terms of the economy is injured. The Federal Reserve cuts rates, meaning there's probably going to be more debt creation and credit creation coming in the future because of the lower interest rates. Where does that money get deployed first? Well, because the economy is hurt, it doesn't get deployed in the small caps and things like that. It doesn't get deployed into businesses and assets and stuff like that. Where it gets deployed into is places where the people with lots of money that they're holding onto right now or will be generating a lot of the cash because of the lower interest rates, those folks, those funds, those banks, they put their money in just a handful of places. Typically, they put them in U.S. Treasuries. Typically, they hold them in cash, and they buy commodities. Commodity speculation is typically the first place that those cash injections go into. Okay. And so at a time when we don't need more inflation, we don't need more price pressures, the money is going to go into commodities and it's going to cause price pressures. Okay. This is the same thing that happened in 2007, 2008. As soon as at the time Greenspan started cutting interest rates again to prop up the economy, because apparently it was all clear and we fixed the problem or whatever. As soon as he started cutting rates again, oil mooned. It spiked. And that's what basically was the death knell right before the fall off from the great financial crisis. So the mortgage crisis created the weakness, but the straw that broke the camel's back was oil prices. Okay. And you could make the argument a lot of commodity prices because it wasn't just oil that rallied. All right. Again, oil doesn't cause inflation, by the way. Okay. Oil causes the inflation number to go up at the very beginning, but ultimately oil is the cure. Energy is the cure for high prices because it is the rate limiting step. It is the brake. It's not like, it's not like you don't increase the price of energy, which then increases the price of everything else. And that causes more economic activity. That's not the way it works. The higher energy goes, the more difficult it is to do economic activity, which then becomes the rate limiter. So if oil goes up here after having been beaten down for a while, and I'll pull up the oil chart, it's up 2% today. Okay. After having been beaten down for a while, if all of a sudden it finds a bottom down here and starts to rally again, that's not good. Consumers have been strapped for a while. If oil rises, that's yet another tax. It's yet another cost increase that's eventually going to cause the consumer to break down even further. Those 56% of people who think the country is in a recession, they're there because they can't make up the stagger. Prices have gone up. Their wages haven't kept up with that, and their standard of living has either dropped or is dropping further every day. If oil goes up, that process will continue, and that 56% will now look like 60 or 65 or 70% of participants within the economy think that we're in a recession, which typically means we are. And it's just a technicality 6 or 9 months later when the bean counters at the BLS and other government agencies finally capitulate and say, oh, yeah, we've probably been in a recession for like 9 months, 6 months, right? Oil's up. That's not exactly a good thing. The other story that I had about oil yesterday was we were talking about OPEC Plus. I wrote about it, actually. If you're not subscribed to the Anarchist Investor Substack, definitely do it. I'm giving away 5 ounces of silver on July 1st. Okay. Let me give you a bigger picture of this beautiful actual money that I'm holding. I'm giving you a chance at 5 ounces of silver on July 1st. You have to be subscribed to the Substack. So if you go to anarchistinvestor.substack.com and subscribe, you get in on it. The first 3 ounces, everyone, regardless of whether or not you're a free subscriber or not, or if you're a paid subscriber, everyone gets a shot at the first 3 ounces. You have to be a paid subscriber to get a shot at the last 2 ounces. Obviously, you have a much better shot at getting silver if you are a paid subscriber. So definitely check that out. And anyway, I did write about the dynamics of the oil market. OPEC Plus basically keeping a lot of their supply constraints in place. There was like some small little silver lining about how they were going to, start to drop those supply constraints a little bit earlier than everyone had expected. And so that means that the price of oil doesn't necessarily need to go up. It can go down because there's more supply coming on board. Now, today, the next day, there's a story that basically says the other oil producers throughout the world, mainly in Texas and other areas in the United States, they're probably going to ratchet down their production if Saudi Arabia and OPEC in the Middle East increases their production, or at the very least, starts taking their foot off of the brake on their production there in the Middle East. And the reason being is because if oil continues to go down, it becomes less profitable for the producers. So they're going to do everything they can to support the price of oil as long as the economy is still holding it together. All right. So that dynamic there, that supply dynamic, all of a sudden everyone thinks, oh, there's going to be more supply. It's going to be a cheaper price. No, that might be true of OPEC Plus. but the entire global marketplace is what you have to look at. And so if there's this dynamic that one place is increasing supply a little bit and another geopolitical area is decreasing the supply, it probably nets out, or it might even result in an even further supply crunch. Okay. But again, remember, the reason why oil has been relatively strong, and yeah, it's drawn down over the last few months, but the reason why it's been relatively strong is because of supply constraints. There was also another story yesterday about how the White House fully intends to begin replenishing all of the oil that they dumped on the market to try and keep the price down early on in this inflation crisis, which, by the way, because oil is the rate limiting step, could have fixed the problem. They probably didn't even need rate increases. Just let oil go up. It would fix the problem. But they couldn't allow that because there was all kinds of political turmoil associated with it. So they drained the strategic petroleum reserve, put all that oil out on the market, artificially suppressed the prices. Now what's happening? This is like government intrusion in economics in a nutshell. They suppress prices at a time when it would have been good to have higher prices to break the back of inflation. Now, when we need lower prices because everyone's basically out of cash, they're going to be buying oil, driving up the price of energy, and creating yet another tax on every single consumer out there who's run out of money. They've run through their savings. They've run up their credit cards to the point where they have the highest level of delinquency rate since the run up to the great financial crisis. They can't afford homes. There's no home supply, right? Interest rates are higher, so all of their debt is more expensive. At the opportunely worst time, the White House is now essentially putting a floor under the price of oil. And everyone wants to be like, oh, they're all like, against big oil and they're against oil company profits and stuff like that. Well, if they are the most inept people I've ever heard in my entire life, because that's exactly what they're doing. They're helping support profits for the oil and the gas industry. So they're so into green energy that they're helping them. And at the same time, kicking the consumer while they're down. Anyway, that's my diatribe on energy. So continue to watch energy. It looks like crude oil is catching a bid too. I'm telling you, this really points to actual inflation coming in the future. And the reason why it's actual inflation is because, like I said in the past, money that got printed in 2020 and 2021, it didn't get spent all at the same time. Some of it got injected really quickly into the marketplace, and really everyone attributed the price increases and the inflation in 2022 to that. But it was only partly that. A lot of it was the supply disruption. Then what happened was all of that money that got printed continued to filter into the economy. 2022, 2023, still getting spent now in 2024. Okay. Well, a lot of that money didn't necessarily go places in the economy and then continue to spread. It didn't necessarily have high what's called momentum. And so it went to these dark pools, these black holes of money that just sucked up the cash and held on to them. And what did they buy? They bought US Treasuries so they could sit on it, make 4%, and just wait. Well, once you start cutting interest rates, we get closer to the point in time where all of that cash finally gets released out into the economy. I've made the comment before. We haven't actually seen the inflation from that money yet. It's coming, though. Look at silver. Look at gold. This price action in silver it's crazy if you think about it. Like where silver is right now. Silver pulled back, regained 30 after it bounced. And here it is now creating this wedge pattern and could eventually move up to $35 or even $40 an ounce. And the reason being isn't because there's a huge uptick in the price of silver or the demand for silver industrially, though there is a floor because of the green efforts and all of the silver that goes into things like solar panels. All right. A topic that I actually covered with Lobo Tigre on the most recent interview. So go over to the YouTube channel if you're not watching right now, or on the Rumble channel, seek out that interview. It's one of the more recent videos that I put up. We talk about that dynamic for silver. But in addition to the industrial demand, which I don't anticipate is going to balloon over time, but it's still there creating a floor. What's really, creating the upward momentum, the upward trajectory here is the anticipation of inflation. That and the uncertainty of the economy moving forward as to whether or not it's actually going to be able to hold itself together. And I've made this point before too. Gold and silver, they're both inflation hedges, though they're imperfect inflation hedges, or I would call inefficient inflation hedges. But what they are more than anything else is they are insurance. And so people today are buying insurance. Why are they buying insurance? Because there's uncertainty. If the central banks have to cut, is it for the good reasons or the bad reasons? Well, gold and silver are up because the anticipation is it's for the bad reasons. It's because the economic numbers are about to get a whole lot worse. Something to keep an eye on. Gold to silver ratio. A lot of people have been trying to like narrow in on, what's the ratio of gold and silver that you should hold physically if you're a stacker, based off of where the gold to silver price ratio is at any given time. I've seen a bunch of different theories on it. Essentially, where I come from on this is this just informs me in terms of what I should be kind of like emphasizing in terms of purchasing. I don't really make big changes to my stack one way or the other, like big reallocations, like sell silver to buy gold or vice versa. But so what I can tell you is at this ratio of 76, that's still elevated, meaning that the anticipation is that silver, at least over the short to medium term, will outperform gold. Now, over the last couple of days, I made the call that gold was going to outperform silver just because of how far down the ratio had come and the fact that we were running up against some significant like technical levels on the ratio. So what'd you get? You got a bounce where gold outperformed for a few days, but over the next, couple of months to actually probably year to 2 years, I fully anticipate silver is going to outperform gold, and you'll see this silver ratio gravitate back down towards 60. Once that happens, my purchases of, my relative amount of money that I'm putting every single month towards gold and silver, it will then even out. Because once you get to 60, you're kind of in that middle level. So once you get to 60, I've been buying more silver than I have been gold. Okay? Once you get to 60, now my asset allocation every single month will rebalance so that I'm probably dedicating the same amount in US dollars towards gold and silver every single month. If that ratio then begins to drop below 60, any, appreciable amount, then that balance starts to re-tilt back towards gold, where I would be stacking more gold than silver once this ratio gets lower below 60. All right. That's just my opinion. That, that's obviously not like the end all be all. There's tons of other ideas in terms of, how you should allocate. Some people trade where they actually, move portions of their stack from one to the other based off of that. That's not me. I'm just looking at, all right, of the amount of money that I have to dedicate towards these things every single month, what proportion am I putting towards gold? What proportion am I putting towards silver? And that's really where it comes down to. All right. So, all right, that's enough on precious metals. Again, commodity space is going up pretty considerably today. The only thing that's kind of lagging is aluminum, but that went up previously because of the tariff stuff. And then uranium's down a little bit. Another thing we talked about with Lobo Tigre was uranium. Awesome freaking video. If you haven't watched it, go over there. Definitely hit up the video. If you're not subscribed to the YouTube, definitely subscribe. All right. Casino continues to sell off a little bit. Let's look at fixed income really quickly. HYG, high yield bonds. So with these rate cuts, you would think that there'd be some level of euphoria, but there's no confirmation yet that the Federal Reserve's actually going to cut rates. So the first things that are moving are the commodities. You'll see follow through in other risk assets if all of a sudden the Federal Reserve, U.S. Federal Reserve, gives you confirmation that they're going to cut rates. You'll see it here in HYG because these are the high risk, the high borrowing rate companies that are out there, the ones that will go bankrupt first if the economy goes sour or if rates stay high for too long. These are the highest, bankruptcy risk corporations that are out there, the big corporations. Well, HYG is down today, but it's not down like a huge amount, and it's still hovering around this level of resistance that's sitting over the top of it. Again, just keeps kind of bumping its head against this level of resistance, waiting for some news to break out. Once we do get that Fed rate cut news, I would anticipate that we get this breakout. All right. Now, it might end up being a fake breakout because you get the Fed rate cut news. It breaks out in anticipation of lower rates. These companies will be helped by lower borrowing rates. But if the Fed cuts slowly okay, which is what we see anticipated from Canada, from ECB. They're not talking about huge rate cuts really quickly. If the Fed says they're going to cut and they're going to do so slowly, you'll see a fake breakout that happens in HYG. And eventually, when the economic numbers start to roll over and look what they actually should have looked like for the last 6 months, you're then going to see it roll back over down and then just basically get rug pulled, because a lot of these companies will go out of business, which they should have back in 2008, if you ask my opinion. So that's what I'm looking at in terms of HYG. U.S. Treasuries. Treasury yields are actually up, meaning there's a little bit of selling here. Part of the selling obviously does not go in line with the idea of rate cuts. If rate cuts are coming, then you would figure there'd be more buying because the rates are going to drop and they move inverse, right? But again, this could be a lot of, the rumor was bought and there's a little bit of selling the news here. And so there's some selling of U.S. Treasuries. Going to have to continue to watch this to see what the follow through looks like as to whether or not. And the big thing that I continue to watch, this is absolutely ridiculous. The inversion between the 2-year and the 10-year still not only remains, but every single time the curve tries to de-invert, bang, it gets slammed right back down. And so we're right back at the level of inversion between the 2-year and 10-year that we were at, for months and months. And so every single day that this yield curve remains inverted is more and more and more damage to the financial sector. So something to remember there. It's also creating that urgency on the part of the Federal Reserve to have an excuse to cut rates. So this next meeting, I wouldn't guarantee it, but I'm telling you, it's highly likely that they're going to telegraph a rate cut at the next meeting. All right. And it's partly because of this too. We've had a yield curve inversion now for over a year, and it's been one of the deepest in history. And typically what happens after that inversion finally de-inverts, boom, everything goes bang. Well, we're moving towards that point. As soon as you get the Federal Reserve telling you that they're going to cut rates, it's that day. Okay. All right. That's everything with the casino. Let's look at crypto really quickly to finish up the day. Crypto did have a bid earlier today. Crypto was actually doing all right this morning. It has since reversed a little bit. And again, what's interesting is crypto seems to follow the stock market. Okay. For all of the, Bitcoin maxis and the crypto bros out there that think that this is like the answer to, the rigged fiat system that works against everyone. The bad news is that if you're tracking the price, right, the price tracks with the fiat system that you think it's supposed to destroy. Okay. Now, there's all kinds of reasons why this isn't exactly destroying the fiat system right now. Part of it has to do with what Roger Ver wrote about in hijacking Bitcoin. And I have an interview with Aaron Day talking about this. That's going to drop Monday evening. So keep an eye out on that. But this stuff trades with the stock exchanges. And so there's a lot of Wall Street influence in the pricing here. There's also just a lot of behavior that's Wall Street-esque with these cryptos, right? And I've made the point in the past that, whether it be Bitcoin or Ethereum or one of these other coins, for the most part, they're looked at by the average person as a technology stock. And most of the average people don't understand them. Okay. And so that's why they look at them as technology stock. But there's also a lot of Wall Street, let me say, tomfoolery that happens in price discovery in crypto. And it's only increasing because of the ETFs and whatnot. I still feel like Ethereum's going to outperform Bitcoin here in the near future. And it's because of that specific news about the Ethereum ETF. We'll see how that works out. If you notice, Bitcoin is, even though it's down, it's outperforming Ethereum. And that, I think, is because as much as these things are NASDAQ stocks, there's also some element of, trading here that happens based off of expected inflation and things like that because of Bitcoin's limited float. All right. Only 21 million Bitcoins, et cetera, et cetera. So when you see these kind of narratives around inflation, usually Bitcoin reacts a little bit better than Ethereum does because Ethereum doesn't have the same narrative. Ethereum doesn't have that deflationary, tokenomics narrative the same way that Bitcoin does. So when you see, news about Fed rate cuts or money printing or deficit spending, usually the activity is more concentrated in Bitcoin than Ethereum or the other cryptos that are out there. But that being said, today, most of the crypto space is down. It's not down a lot. It's just down a little bit, maybe about, the total crypto market cap is only down about 1/3%. So this is not some big tectonic shift in terms of where it's headed. But that being said, Bitcoin is down a little bit. And again, this could have been a buy the rumor, sell the news kind of situation related to rate cuts. Okay. And it's mirroring the activity that's happening in the stock market. Are there any outlier? Not really. I mean, there's a couple of small outliers here or there. Some of the micro caps are kind of outperforming on a relative basis, but nothing like earth shattering, like small micro cap. And if I go to the daily charts, these things have had big moves. And so these moves today aren't exactly, gigantic, but, cryptos that are out there like Geode and Demo and, what's some of the other one? The gold and silver cryptos I continue to be a holder of through Kinesis. So Kinesis Money. Definitely check it out. If you're interested in a platform that gives you exposure to like that kind of hybrid between gold and silver and crypto, Kinesis is one of the best that I've seen so far. If you know of another one, please throw it into the comments. But also, regardless of where you're watching or listening to this, there is a link there that's a referral. You can get some free incentives to go over there to Kinesis and, just try and fund it for a couple of bucks and figure out what's going on and use the platform. So I found it to be pretty good. The only thing that's missing is in the United States, they don't allow the virtual debit card that actually allows you to transact as if it were your checking account just yet. So we'll see whether or not that changes in the future. And that's all I really got. That's really the market analysis for today. I mean, rate cuts, we're going to have more rate cuts coming forward here. I would fully anticipate. And that's really going to be the dynamic. I'm worried. I'm worried that we will see a period of disinflation or deflation as a result of economic weakness. But I think any of that deflationary pressure will be short-lived because it will be met with an overreaction from the Federal Reserve and a complete lack of understanding that there's all this cash sitting in the sidelines. And once the Federal Reserve starts to, considerably decrease interest rates and lending rates and allow for more credit creation again into the future, you're going to see that money get unleashed. And unfortunately, the first few places it goes is the places that cause more and more and more inflation: energy, gold, silver, commodities, et cetera, et cetera, et cetera. So we're going to continue to watch this moving forward. I will be back here tomorrow, Friday, to close out the week. So as usual, I'll be here live, noon Eastern. And again, any help you can give me with the algo would be fantastic. If you made it this far in the video, thank you so much. I appreciate your support, your time, your energy. And with that, I'm going to see you tomorrow. So have a fantastic afternoon. Peace.
Stuck in a system that just ain't right. Gonna tear it down. Gonna start a fight. Anarchy and numbers is my game. I'm the investor with no shame. Greed and corruption, that's the name of the game they play. It's all a shame. I won't play by their rules. I won't comply. Anarchy's the way. It's time to fly. the show with my rebellious spirit. Watch me grow.